members that would be inheriting from you. And before we go into too much detail, just a couple quick reminders. If you have any questions, we can see the questions come up on the Q&A function. So if you submit those, we'll see those come up. And then you'll be receiving a couple things from us as well through your email that you use to sign up. That will be a feedback form, which gives you a place to, of course, give feedback, but also tell us if you'd like to reach out or have us reach out to you to set up an initial consultation. Those are complimentary. We do schedule them for about 2 hours. So, gives us plenty of time to go through your situation and discuss what we might, have to deal with your family's planning and with your estate plan, and any questions that you might have. But we can reach out to you if you fill out that form to set aside time to do that. And then you'll also be receiving a couple handouts from us. And then just another quick reminder that next week, our topic is actually on avoiding family conflict. So one of the most important things we do when we're planning is help eliminate or avoid the possibility of family infighting, based off of maybe decisions that were made or planning decisions that were made. And we've seen examples in the past where those decisions can create that conflict. And then the following week, we're actually going to be talking about 6 things that you should avoid if you are providing care for your family member. So a lot of times children provide at-home care or help out at home for loved ones when their parents are maybe time soon. So, that's a really good one to go through and listen if you are considering that situation for your parent. But again, today we're going to be talking about avoiding taxes, so the more financial side of it. And there's really 2 main types of taxes that we're looking at when we're talking about avoiding taxes, although 3 depending on your situation. So, when we're talking about taxes, what's the one that we're probably the least concerned about for most people?
Sure. So if you're worried about like estate taxes, the size of your estate matters. So the reason Justin says most people aren't going to be worried about this tax is you'd have to have $12.9 million each. So you and your spouse would each have $12.9 million in order to have a taxable estate concern. So while we're certainly happy to help you with that, if you have that problem, it's just that that's going to apply to a very small percentage of the population. So we don't talk about those types of estate taxes as much in today's webinar. The other kind of taxes we're going to be talking about is capital gains taxes and then income taxes.
Mm-hmm. And with estate taxes, another follow-up question we often get is, well, do my kids have to pay any taxes on what they receive from me? And what that's generally referring to is what's called an inheritance tax. So an estate tax is when your estate, before things get divided up, pays the tax on any overage, over that 12.92 million per person. So, if you're over close to 26 million for a married couple, you have to pay about a 40% tax on the overage. But an inheritance tax is something that the children pay based off of how much they individually receive from you. Again, we don't really talk about that because in Wisconsin, we don't have an inheritance tax, and federally, there's no inheritance tax. So you also don't have to worry about taxes from that angle, but you do have to worry about capital gains tax planning and income, just general ordinary income tax planning, because there are certain things that tax planning can help you avoid entirely, and some planning that can help you lessen it, but maybe not eliminate it entirely. So capital gains is really the easiest tax that you can avoid.
Sure. So one of the things to think about first of all is, what items, if you've heard the phrase a step up in basis, meaning adjustment for capital gains, what is an asset that would have potentially capital gains? So for some of our purposes, just know that this is a general overview or a simplification of capital gains, but for the most part, your home could have capital gains. Stocks, other things that really would appreciate or depreciate would receive a step up in basis when you pass. So a really easy way to think about capital gains is just to think, if you had purchased your home we'll go to the 60s, ignoring the housing market a little bit today, but you purchased your home in the 60s, you paid for easy math, $60,000 for it. And then when you go to sell your home today, it would be the difference between what you bought it for and what it would sell for. And a capital gains tax is normally, 15 to 20% tax for most people, when you're thinking about, the capital gain on your home from what you bought it compared to what you sell it for, you're going to get what's called a 121 exemption, because it's your primary residence. You lived there the past out of the 5 years, or 2 out of the last 5 years. So for the most part, people don't typically pay capital gains taxes on the sale of their primary residence. But then the question is, if you had that 121 exclusion, what happens if when you pass, you left your home to your kids? Are they going to pay capital gains taxes if they sell that home? Because obviously it's your principal residence, not theirs. So I guess the nice part is when you receive an inherited property, so inherited stock, inherited real estate, things that are subject to capital gains taxes, is it receives a step up in basis. So it's reevaluated as of the date of your death, which for most people, if you sell it around that same time frame, would mean that there's no capital gains on that property or that stock that your kids would be paying.
Yeah, and the reason this can become an issue for people, or those types of assets can become an issue, and I would say probably primarily it's an issue with real estate because of the way people do this planning, but a lot of times people make the mistake of transferring that property to their children during the lifetime of that individual. So before they pass away, they're not inheriting it, they're gifting it over to them, just signing the deed over. A lot of people do this for, I guess, a variety of reasons. If it's like family property, maybe they want to transfer it over during their lifetime and just say, yeah, it's yours now, you deal with it. Other people do this to try to protect that property from long-term care expenses, try to get ahead of the 5-year look back and say, well, I'm going to gift my property to my kids so that the nursing home doesn't get it. And the problem with gifting property over, as Abigail was talking about, is that it does not receive that step up in basis then when you die, because you don't own it when you die if you've already gifted it. So you transfer what your cost basis was over to the person you've gifted it to. Now, if they buy it from you for fair market value, that's different, right? They paid for it, that's not a gift. But the reason this is such a common problem is because people do often just gift it over to the kids.
Or they do like a sweetheart deal, they for $1, that's an extreme example, but they give a discount or to your loved one lesser than fair market value. So think about that too. If you've given it for a very nominal amount of money, that still could be looked at as that gift, or their basis is then whatever they bought it for. So if they bought it for $1.
Unless the dollar example, if you do such a de minimis amount like that, then the IRS still says that you gifted it for the current cost basis. So thankfully they don't mark it down for $1, but it's still not good tax planning. If you think it's possible that the kids are going to sell the property, if you think it's possible at all, I know the goal often with these family properties is not, they're not trying to have it sold right after their death. They're trying to keep it in the family, but it still does, give them a lower cost basis than they would have received through inheritance. So again, people often try to do this for long-term care protection, to try to get it out of that, the parent's name into the kid's name. And you can avoid that issue if you use different types of planning that still could protect it from long-term care costs and from spend down and all of that, but also help still receive that step up in basis to avoid the capital gains issue later on. So capital gains, that can apply to any sort of real estate. It can apply to stocks. It just more often than not applies to real estate, because that's mostly what people are talking about gifting. Although every now and then I'll have a client say, I want to gift this stock that I've had for however long to my grandkids. And it's like, well, maybe wait. You can leave the money to them now, or gift cash to them, and that's not an issue. But if you gift stock to them, they're going to have capital gains tax to pay on it. So that's a really big, probably the biggest concern we have tax-wise, that really you can eliminate entirely depending on when your kids or the next generation is deciding to sell these properties. If they hold on to it for a while afterwards, yeah, they still have to pay the capital gains tax on the appreciation in between that period of time, from when they inherited it to when they sold it. But it's still going to be minimal compared to what it would have been if they had your cost basis in the home from the 1960s.
Yeah, and it could be important too if you start to think about, well, I have a property that I know my parents gifted to me. So think of that cabin example. Like they gifted it to me, and I know it was gifted to them. And then you start to go back a couple generations, and you think, well, what did anyone pay for this, or at that point, even the land rather than the home. So you could have a significant amount of almost like stacking of capital gains if it was like gifted from a parent to a child and kind of so on for a long time. So even if you held on to it and had everyone receive the inheritance, it's that step up in basis that's really so key sometimes with those properties. Even if people hold on to it, we'd all hope that, but circumstances could change, and it's still better planning, better control for you and for your kids.
And where that compounded gifting is very commonly an issue, I would say, is you see like farm families have like over the generations maybe gifted portions of it or parts of it to the next generation, and it's just been regifted. And so these the cost basis in these properties could be really minimal. And also that's a group of individuals who tend to depreciate property very quickly. And so that means they might, even if it wasn't gifted to them, have a lower cost basis. So if you are a farmer and you have farmland that you're trying to pass on for the next generation, you can still get a lot of benefit from the children who are going to continue the farm inheriting that property or purchasing it, rather than you gifting that property to them, because it resets that cost basis again based off of whether they purchased it or inherited it. So with the capital gains discussion, I mean, it's something that you can really eliminate entirely. And we did just get a question of, do the stocks get a step up in basis if these stocks were used to fund a child's special needs trust before the parents pass away? So if it was used to fund that trust prior to the parents passing away, then no, it would not receive a step up in basis at that time. If it's left to a supplemental needs trust as part of their estate plan, so if they owned it still when they died and then it left it to that supplemental needs trust through the estate plan, that would get a step up in basis. So it would ideally be better for that supplemental needs trust to be left those stocks at death rather than used to fund them pre-passing. However, there is always exceptions to that. I mean, if there are concerns about like long-term care expenses, for example, that could be really helpful to fund a supplemental needs trust for a disabled child, which then doesn't count as a divestment for the parents. But again, there is exceptions to those rules, but it is certainly, if you can do it, better to inherit the supplemental needs trust and have the stocks be left at death. So the other tax that we are especially dealing with more now, that may have been less of a concern in the past, is one of just ordinary income taxes for beneficiaries. So where this really comes into play is with inherited retirement accounts, because you're not going to pay income taxes just if you receive cash. That would be an inheritance tax if that's what happened. You're not going to pay income tax on that. What somebody has to pay the tax on is either the parents or the children have to pay taxes on pre-tax retirement accounts like IRAs, IRAs, 401ks, 403bs, any of those types of retirement account plans where you put pre-tax assets in. Now the Roth, which I was sort of getting ahead of myself on, the Roth accounts, those are post-tax, and you've already paid the tax on it then, or somebody did. So an inherited Roth account, we're not worried about the income tax at that point. But because so many people have a large portion of their estate in their 401ks or in their IRAs, and that's pre-tax, that is money that somebody still has to pay the tax on. And if it's your account, at a certain age, at 73 now, you have to start taking money out of it based off of your life expectancy. You'll pay the tax at that time. But one thing to consider to help eliminate some of those tax concerns for the next generation is, do you want to do some lifetime planning where you pay maybe more of the taxes on it than your required minimum distributions would require? The new rule over the last couple of years for inherited retirement accounts is that most beneficiaries, other than a few minor exceptions, have no more than 10 years to liquidate those accounts.
It used to be that someone would have an entire, their life expectancy at the point that they received to kind of take out those retirement funds. And when you're paying your regular income taxes, or in this case, the beneficiary's regular income taxes, what that allowed them to do is kind of, take chunks each year, and then they wouldn't have such a major tax hit. But with the Secure Act change in 2020, everyone except for, those exceptions, you could still do rollovers for spouses. There's some exceptions for people with disabilities, minors, but really other than those things, what you're going to be looking at is a 10-year window to actually take out those retirement funds. And that does apply to Roths, and it does apply to, your traditional pre-tax funds. But the problem with your pre-tax funds is just the fact that you're having to take out more each year across those 10 years. And then you're going to have a more significant impact on your income taxes because you're down to those 10 years instead of the lifetime stretch. So exactly what Justin was saying before with the Roth conversions, what that really allows you to do is you could, working with your CPA, figure out, what that gap is, that space that you have between where you currently fall in your income tax bracket and the top of that next percentage. So if you just take the difference between the two and actually pay some taxes now at your income tax rates in retirement, that there's a chance that, that's less than what your kids would have paid, and you can actually start to take down some of those tax consequences, even if you needed things like long-term care planning. So Roth conversions are good for long-term care planning, and also if you're trying to reduce the income tax liabilities to your beneficiaries.
Yeah, so I mean, the point of with the 10-year stretch now, or it's not a stretch, it's an eliminated stretch, the 10-year rule for paying out those retirement accounts is you sort of have the worst case scenario for a couple of things. One, they now have to take it out much quicker than they used to. If I inherited a retirement account at my age, I'd have had something like 50 years to take it out under the old rules. So I'd have a long time to stretch out those taxes. Now, if I only have 10 years, that's expediting the rate at which I have to pay taxes on it because I'm taking out larger chunks. But the problem with that 10-year stretch is it's higher tax rates, higher taxable amounts rather coming out, while most beneficiaries who are inheriting are in their prime earning years. So when you look at the average age of passing away, those people's kids might be in the highest income brackets they're going to be in for the rest of their lives. So not only are they taking out more that's taxable, they're paying it at a higher rate than they would have earlier in their life, or maybe in retirement. So you in retirement being able to do some tax stretch planning yourself and draw it out longer at smaller amounts means that you're saving more money in the long run. And certainly the earlier you do this planning, the better, because then your Roth accounts that you have grow tax-free for the rest of your life too. So it's very beneficial to do this earlier rather than try to hurry up and do it right at the end, because you're going to be paying higher taxes yourself. So again, just the exception to those 10-year rules though would be a spouse. They can still roll it over and treat it as their own. A minor child of yours, so it has to be a minor child of the original owner of the account, can get a life expectancy stretch up until age 18, and then they have 10 years. Somebody with a disability, according to the IRS, meets that definition. So like a supplemental needs trust, for example, if it sees through to the beneficiary with a disability, if it qualifies as a see-through trust, then it can still receive that life expectancy stretch for that beneficiary. Has to be set up the right way, so don't just assume it would, but it can still receive a life expectancy stretch on that pre-tax IRA. And then the weirder exception is somebody not more than 10 years younger than the original account owner can still receive a life expectancy stretch. So like if I left my IRA to my brother, he would get a life expectancy stretch still because he is not more than 10 years younger than me. So, with this type of planning, it's good to work with your CPA, as Abigail mentioned. It's good to work with your financial advisor or the account custodian to figure out how much of this to convert in any given year. You're never going to do it all at once. It's going to be drawn out hopefully over years. But with a Roth account, the kids do not have to, or the beneficiaries do not have to pay any taxes at all when they're taking out the distributions. So the reason this is a good way to eliminate or avoid certain taxes for income tax purposes is because then the kids don't have to pay taxes when they're drawing it out. Like Abigail said, it's still 10 years that they have to take out that account, but then they're not worried about taxes. And in fact, with Roth accounts, not only do they not have to take required minimum distributions over those 10 years, they can actually wait until the end of year 10 to liquidate it entirely, which means then during those 10 years, it's grown tax-free. So if I inherited $1 million in a Roth, I would not touch it for 10 years. Because,
well, yeah, assuming you don't have to.
Assuming you don't have to.
So
yeah.
I mean, always if people need it, then it's, available to them. But it's one of the nice parts about letting it grow tax-free is you've already paid that tax, and you continue to let it grow, assuming that you don't need it or don't have other uses for it that you'd rather utilize.
Yeah, another way that you can eliminate some taxes on pre-tax accounts is if you have charitable intent. If you want to give to charities either during your lifetime or at death, that's a perfect use for a pre-tax retirement account because charities do not pay income tax. So during your lifetime, when you have to start taking required minimum distributions, if you feel that you don't actually need those required minimum distributions, if you're living, well enough on your own, you have other good sources of income, you're doing fine with other investments, you just don't need it, and you were already going to give some money to charities, in place of your required minimum distribution, you can work with your advisor to do what's called a qualified charitable distribution, or shortened to QCD. So what that is you directly from the retirement account and qualified it as a QCD, you give that money instead to the charities you are going to give money to, and then you don't pay tax on it. The charities don't pay tax on it. It's the most efficient way to give that money if you're already going to give to charity. Now, this obviously does not work for everybody because not everybody has that charitable intent, but if you do, it can be a really good way to eliminate taxes entirely. And then at the end of your life, if you're going to leave any money to charity, the best way to do that is, again, directly from the IRA, because then you're not having it pass through something else first, where then that money has to be given out to the charity. You can just directly name the charities on the account. And some retirement accounts will allow you to do what's called a pecuniary amount, so a specific dollar amount, instead of a percentage of that account, if that's what you'd rather do. But that's a little more hit or miss depending on the company. So you have to check with that if that's what you're trying to do. But yeah, if you have charitable intent at the end of life and you have a lot in pre-tax retirement or just some in pre-tax retirement accounts, that's the best thing to use that money for, because you're not going to have to pay tax on it yourself. Your kids won't have to pay tax on it, and the charities don't have to pay tax on it. So it's basically a one-for-one exchange. You're not having to do any deductions. You're not having to do anything like that. That's just giving it to that charity. So it's really helpful if you have charitable intent to do that type of planning, to use the right assets for that charitable giving. So again, that's not going to work for everybody, just because not everybody has that intent. But it's if you do, it's a great use for it. And then there's a lot of other more complicated charitable strategies that people with very large retirement accounts might use. For example, things like a charitable remainder trust, charitable lead trust. There's ways to do some further tax planning too, especially kind of the joke that we have is the neurosurgeon who has a $3 or $4 million IRA, leaving their $3 or $4 million IRA to their child who is also a neurosurgeon, right? So high tax bracket, large amount of pre-tax money, leaving it to somebody who's also in a high tax bracket. There's a lot of complex planning, but very good tax planning that can be done with those larger amounts to it. If you don't want all of that to go to the charity, you can do some further planning too. So yeah, both charitable giving, Roth conversion planning, very good to eliminate or lessen the tax consequences for pre-tax accounts. Abigail also mentioned long-term care as a planning reason to do this. So part of the reason for that is a lot of people, when they're going into care, are trying to find ways to move some amounts, to not have to spend through everything, to be able to supplement their care later on. And with pre-tax accounts, especially IRAs, 401ks, if you transfer ownership of those during your lifetime, that is treated as if you took all of it out, which means it's taxed at that rate, whatever the amount you took out. So it's much better to have to do that with a Roth account, because you don't then have to also worry about how much you have to pay in taxes. You're just worried about how much of this can we move or protect. But if you still have pre-tax retirement accounts that you're trying to efficiently use at that time, you have to usually pay for a certain period of care yourself. A lot of facilities require 1 to 2 to 3 years of private payment before they'll let someone stay there if they've run out of money and gone on Medicaid. Well, if you have to do that anyway, and you have a pre-tax account, you want to use that account to pay for that period of time, because you also get a deduction for unreimbursed medical expenses that exceed 7.5% of your adjusted gross income. So you have the ability to basically get that one-for-one exchange again by using that money to pay for your care, if you have to pay for your care for a certain period of time anyway. All right, so I don't see any more questions, and we're almost out of time. So I'll just remind everybody again that keep an eye out for the materials that we'll be sending to you, especially that feedback form. So if you'd like to come in and talk with us about this planning, or really about any area of estate planning that you have questions on, please let us know through that form that you'd like us to reach out to you to set up that complimentary initial consultation. And then just a reminder that next week we're going to be talking same time on avoiding family conflict. So really just going through some sometimes legal ways to avoid family conflict, but also some practical steps that you can take, planning steps that you can take to avoid creating more of a problem than there needs to be. And you're never going to fully eliminate the possibility for conflict, just to put that disclaimer in there, but you can do a lot to avoid it. So with that, I hope everybody has a good rest of their day, and we will see you next week.